Bailador obviously invests in maturing startups that are predominantly unlisted, and it's a relatively illiquid structure, I understand. On that basis, what's the benefit of investing in an investment vehicle like Bailador, which is a listed investment company?
Sure. So you're correct. We invest in technology companies at the expansion stage when they're private at valuations that are more attractive than you can usually find in the public markets. So that's what a lot of investors are looking for, because you can get really big upside from that. The problem historically has been that the only way to get access to that style of investing was commit at least $1 million for a 10-year period to a blind pool. You didn't know when the capital was going to be drawn, when it was going to come back, or what you were going to really get exposure to. And so Bailador addresses that. By being a publicly listed company with a portfolio of 10 investments, investors can see what they're going to get exposure to. They can top up and get more investment by buying shares at any time. They can sell at any time. Our market cap's over $120 million. Liquidity tends to be around $100,000 a day, which is plenty for most people to get in and out as they choose. And so it's a pretty exciting opportunity for the Australian market.
Is it correct in saying, though, that you're heavily weighted towards a couple of holdings in that 10 strong investment portfolio? And why is that the case? If so, like we do hear from a lot of people, don't put all your eggs in one basket. That's the mantra for investing.
Sure. So as I say, there's 10 companies, so it is a portfolio, but it's very true. Our largest holding now represents over 50% of the net tangible asset value. It's for a very good news reason. We invested $5 million some time ago when the business was turning over only $5 million themselves. That's SiteMinder. SiteMinder now turns over more than $100 million, so it's 20 times the size of when we invested. We have sold down a little bit along the way. Actually, we sold a $5 million position some time ago at 8 times our entry cost, and so we really de-risked it and took the cost base off the table. Everything from here is cream, but it's a world-leading business that we can talk a little bit more about if you like, but it's because it's been so successful and it has such great prospects ahead of it that it's grown to be the largest part of the portfolio.
You do like having skin in the game in your companies on many different fronts. So it's not so much only, you're a big investor in Bailador itself, which is BTI on the ASX, but you also like investing in companies where you can occupy a board seat, or someone from Bailador can occupy a board seat. So can you tell us a little bit more about this?
Sure. So the first point you make is very accurate and very relevant. David Kirk and I have invested $12 million in BTI shares, and so it's that concept of skin in the game, alignment with other shareholders, and really showing everyone that we believe in the portfolio and we care deeply about how it's traveling. Then within that, the Bailador team, including David and myself, will be really very active managers of the portfolio. In practice, what that means is taking at least one board seat and being a sounding board and a counsel to the founding management team as they go on that journey to grow their business to be a world leader. David and I have a fair bit of experience in doing that, in helping companies grow from Australia, go global. And so we find that the founders, when they come to us, they're really looking for that help. They're looking for some capital and some help. They've got their business to at least $5 million revenue themselves. They see a big opportunity. They don't want to take any money off the table. They want to keep all their skin in the game. We join them, recruit an A-grade management team to help go after those big opportunities.
You're certainly in an interesting space then. You're dealing with scale-ups more than startups.
Correct.
So could you please explain the difference to people watching at home? Because a lot of people hear about startups, but the word scale-up isn't exactly in our lexicon day to day.
Sure. So for Bailador, a scale-up or expansion capital is another term that we use, really relates to companies that already have a proven technology, a proven business model, a proven management team, a really good product market fit. In terms of numbers, as I mentioned, they usually have at least $5 million of revenue, if not a lot more. They're usually led by the founding management team, but they've started to add particular specialist skill sets around them. And so that's the point at which we will get involved, when they've moved through that frankly, pretty highly risky startup stage, and now it's about executing and repeating on a formula that works, and bringing in place that discipline so that you can repeat it reliably. I would contrast that with a true startup, which is often pre-revenue. It might have a product, it might be just an idea, or it might have a little bit of revenue, but only really proven with a handful of customers. Most of our businesses have hundreds or thousands of customers by the time Bailador invests. We particularly like the software as a service business model, which involves a recurring subscription revenue. So there's a very high degree of predictability of revenue. If you put that together across the 10 companies in the portfolio, they have underlying revenue of over $230 million. So that's pretty good critical mass and a pretty good track record of success that you just won't be able to see in that startup phase.
Maybe if you could tell us a little bit more about some of your favorite ideas in the funds. You mentioned that you love software as a service models, so everything can basically be as a service these days, can't it?
Indeed. Hopefully not journalism as service.
Hopefully not.
But obviously SiteMinder is a big favourite, making up half the portfolio, so I'll start there. SiteMinder is a great Australian success story, largely unknown yet, partly because it is a business-to-business operator. It's not a consumer brand. What SiteMinder does is it helps hotels distribute their room inventory through online channels. So it won't surprise many people to know that over 50% average worldwide of hotel rooms are booked online. And there are hundreds of ways to do it. Most people will be familiar with names like Booking.com, Expedia, Travelocity, Ctrip, Airbnb's doing it now, TripAdvisor. And so if you're a hotel, what you want to do is be visible on as many platforms as possible in as seamless way as possible. That's what SiteMinder helps the hotels do. And pleased to say that SiteMinder has grown to be far and away the world leader in this space. They've got more than 35,000 hotels subscribing on a monthly basis. They're more than triple the size of their nearest competitor by any measure. And yet they've got a huge greenfield growth opportunity in front of them. There's more than 800,000 hotels in the world. And so SiteMinder's going about farming that. They're not just a local champion. More than 80% of their revenue comes from outside Australia. They're the world leader and they're the regional leader in the US, Europe, Asia, and any country you care to look at.
As you've mentioned, it's really hard to get access to these kinds of companies, these early stage or these scale up companies, and particularly for retail investors. So we've seen the rise of equity crowdfunding, but there's limited opportunities on those kinds of platforms. So Bailador is obviously in a really unique space through the BTI model, and I don't believe there's many other listed investment companies operating that way. But it's tricky as well, because last year, you know, there was a lot of talk around some of these early stage investments, and the share price was kind of languishing. But this year, you've had a really strong year. So what do you put that down to? And even a little bit about the premium and discount situation when it comes to trading a LIC. What does that mean in layman's terms?
Sure. So there's a few elements to the answer to that question. The first one I'll deal with is the style of investing we do. Because you're investing in a private company, you can't just front up with a check and then next week change your mind and pull it out. You're committing to a real partnership. It usually means 3 to 5 year hold period, growing that business and preparing it for a stock exchange listing or to sell. And so that takes time to prove out. And the public markets tend to, if I can generalize, be a little bit more short-term driven. So I think that's probably why we were trading at a discount for a while. But as the evidence starts to build, the discount has narrowed. So we've now had 19 third-party transactions, meaning investments into or sales of pieces of the companies that we're involved in. I'm pleased to say that 19 out of 19 times, the implied valuation has been at or above our carrying value at an average uplift of 88%. And so that's a pretty good, sizable body of empirical evidence now that actually Bailador is being conservative in their carrying values. Maybe the share price should be at or above those carrying values. The other thing that we've done is had 4 partial realizations, because nothing tells the truth like cash. And so as we've started to demonstrate that, once again the share price has started to lift. We are unique in Australia. There is no one else that focuses on technology investing in private companies that you can access through an ASX traded share. Now, it's understandable that it takes a while for the market to become familiar with that. If we look overseas, in the UK, there are a number of companies that look quite a bit like us, and they generally trade at or above their NTA, so mostly at a premium. David and I think that we at Bailador will also trade at a premium, but we think we have to earn that right, and you earn that right by continuing to sell businesses at profits and at above the levels you're carrying them at. And so right now there's an opportunity for people who believe in us or who understand the portfolio to get in and get an extra premium as we migrate towards those levels. And that's over and above the underlying 30% growth rate that our portfolio enjoys.
As always, it's a case of catch up in Australia, isn't it, compared to the rest of the world?
Well, it often is, but better to have the opportunity than not at all.
For sure. Thank you so much for joining us today, Paul.
Pleasure, Laura. Thank you.